Okay, welcome to the Swing Trading with Cycles channel, where we time the markets without predicting the markets. We do that by analyzing the trend so that we can identify trend reversals early. That allows us to get into trades early in that trend reversal, identifying when a downtrend ends and an uptrend begins, for instance. That's when you go long. You will not catch the exact bottom. That is impossible to do consistently. But you can spot the trend reversal and enter with the trend as early as possible so you can ride the rally as much as possible, right? And then you want to exit on the swing high depending on your time frame, right? That's what we teach on this channel. It is October 4th. We are going to look at some macro charts. What I mean by that is like macro things. So we're going to look at Dixie. We're going to look at the 10-year yield, right, to understand where rates are going. We're going to look at TLT, which is just a mess, really just kind of awful, right? And we're going to kind of try to understand, because those things are really going to correlate with where the broader market is going. Are we getting a more sustainable bottom here, for instance? We'll also look at HYG, which is a high yield bond index, and we'll look at LQD, which is your sort of corporate grade bonds. And so really focus here on bonds and the dollar. They always say the bond market is smarter than the stock market. I don't know that that's necessarily the case, but it's just math that it is larger than the stock market, much, much larger. There's a lot more capital in the bond market in general, and certainly just trading currencies in general. So there's a lot of capital at stake, and so what those things are doing tells you a lot about the path of things, right? And so this is the Dixie. It starts to trade at 8 p.m. every night. It's about 9 p.m. as I'm filming, 9:30 as I'm filming this. So we've been trading for about 90 minutes. We are threatening to make new lows on the daily. So this is day 16 that's opening, I believe, right? So we have a swing high from day 11. This is day 12, 13, 14, 15, day 16. And so I'll just mention this. This is important. Like, people will say like, oh, well, what about, is the count, like, could the count be different? Like, is it possible that like, this is actually day 4, this is actually day 39, right? And this was a top on day 34, right? Yeah, that could be. And that's why when these are labeled, I think the easy way to kind of think about it is add this number 23 to this one 11, so you get that 34. So okay, this is potentially actually a day 34, and we're moving into so this is a longer daily cycle versus this being a cycle that is 23 days. It has a top on day 19, and this being a cycle that has a top on day 11 and is day 16. Honestly, it doesn't really matter, because what you're following is the price action and what we've observed very clearly. And what I'll say is, if you haven't seen the Cycles 101 content, please take a look at the links in the description. There'll also be a link at the end of this video that'll easily take you to that. But definitely take a look at that. I'll assume that you've seen that content. But this is, so as I'm talking about, cycle related things like daily cycle lows, etc. So the first thing that you look for is a swing high. And we have a swing high once we essentially went below this candle, more or less. I'll just mark that so that's clear. So once we went below this candle, right? Because this candle made a new high on day 11. And then we just kind of failed and went red. And the following day we made a lower high. This was a green candle at one point. It looked like we were going to, make a move. And then we just made a new low. And so once we went below that low, that was, to be clear, 112.561. So once we went below that level, that was a daily swing high. And this line here is your 10-period moving average, so your 10-day moving average in this case. We also happen to close right on that, and you'll generally close below the 10-period moving average as part of a cycle decline, right? So if it's a weekly cycle decline, it's the 10-week moving average. If it's a longer term cycle decline, it'll be the 10-month moving average, maybe even the 10-quarter. The 10-period moving average is just a helpful way to gauge the short-term price, right? because you're essentially just looking at the average price over the last 10 days, which tells you how it's trending essentially. And so right now it's clearly starting to turn lower. We've closed below it. We're making new lows. And again, that's important. Just observe. We're continuing to make lows below the low of the previous day. So we made a new low this day below this low. We made a new low this day below this one. And so you would expect we're going to make a low below this one here, right? We're going to continue the daily cycle decline. And so what that will mean is that that daily cycle decline will also become a weekly cycle decline. So the same way the daily cycle, we have a daily cycle, we also have the weekly cycles. And the same way we have a swing high on the daily, you guessed it, we now have a swing high on the weekly. To be very clear, this is how multiple time frame analysis works. This is the point. Once we had that daily swing high, that created the conditions to create the weekly swing high, which we have now. Because we had the bearish follow through to the downside, we now have the weekly swing high. And this weekly swing high is below 111.576, right? The swing high is always below the low of the candle that marks the high. And so this is week 17. So like it's this rally that we're looking at. And this is your 10-week moving average, right? And so you can see we've just kind of been moving up relentlessly. And so it makes sense that we're pulling back here, right? And notice that we're still above the 10-period moving average. So that's a really just simple rule of thumb. We're probably going to at least touch that, if not close below it. Now notice this mini decline here. So we had this high and then we started to top out. So this is week 1, week 2, week 3, 4 weeks, and then we make a low. Notice that we closed just like a hair below the 10-period moving average. So we might be in for something like that, maybe 3, 4, maybe even 5 weeks of decline, basically the month of October. Now, it could be that we just kiss the 10-period moving average and then kind of bounce up. That's what we're going to have to kind of watch for. I would assume it's going to be at least a 20-week cycle, and so this is week 18. So you imagine we have another week next week, week 19, and then we get our final low on week 20 at least. This cycle was 20 weeks exactly. This one was 33 weeks. This last one was 20. So they tend to be in the 20 to 25 week range, but sometimes you get a really long one here, like this one. So if we are going to get a longer one, then that means it's going to be even more bearish because it means it's going to give it more time to kind of decline. So that's what we're going to watch for. In terms of levels, you can think about the 10-period moving average as your one of your minimum levels. We're probably going to cross below that at least. And I suspect we're probably going to test the 107.77. We're probably going to test the 107.758 area. Call it broadly 108. It feels like we're going to kiss that. And that's about 2% from here. That's a pretty big move in currencies. If you want to play the dollar specifically, UUP is the way to do it. They have very, very low vol options, which are useful. I'm waiting for this reversal I'm waiting to see if this. So this is my play. Like one scenario is we just get a higher low, right? Because we've been in this uptrend this whole time, right? So one scenario is we get something like this, and then we just kind of resume higher. I botched that, but you get the point. So I'm waiting to see if something like that materializes, and then a nice call spread on UUP could do really well. And if we look at the monthly chart, now this is where it gets really important. We have those long-term cycles. In this case, it's the 3-year cycle. The 3-year cycle that we're in right now started on January 2021. So it's pretty simple. We would think that it's going to last for about 3 years. So that means all of 2021, all of 2022, and all of 2023. So the question is, when are we going to get the top, right? When are we going to get the high for the 3-year cycle, right? This last 3-year cycle that just ended on January, that ended, I guess, technically December 2020, because, this 3-year cycle we're in right now started on January 2021. That was a 35-month cycle, so it wasn't exactly 36 months. They're never exact. That's an important just rule of thumb. That cycle topped out on month 25, and that was actually your COVID crash when everybody was like flailing for dollars. And you can see really ugly candle because we crashed really low and then we went really high and then just so really, really ugly. But that's when we flamed out. So month 25, you could argue that we almost kind of flamed out here and then we got kind of bailed out by that crisis. But the point there is last month was month 20. This is currently month 21, and it's an inside month. I've drawn this. These lines are pretty clear. The low from this month is 107.68, and the high is 114, right? And so we're just inside that range. And that's why that level becomes really important. Call it the 107.5, because if we go below that level and we don't recover, then this becomes a monthly swing high. And this means we could be starting the 3-year cycle decline the same way this was the start of the 3-year cycle decline, right? Let's just see how much we declined, like percentage terms. And let's even say like, let's say decline from like here. So that's about an 8% decline, which 9% decline. I mean, I guess this wasn't a huge rally though. Like to here was 11%, even to here was 15. And I mean, look at what this rally has been. Just for context, I think it's been like 30%. Oh yeah, I mean like 30%. I mean, that's pretty incredible. And obviously the Fed starting to tighten has made it kind of go just ballistic. But also notice how far above the 10-period moving average we are for the monthly, the 10-month moving average, to be clear. That's like in the 104 range, and we're sitting up here at 110. So at some point, we're going to get the beginning of the 3-year cycle, decline. And I emphasize this in my videos. It's really important. You want to try to mitigate emotion as much as possible. And one way and one benefit of that is trying to like avoid FOMO. And one way you do that is reminding yourself these moves last for months and actually years. So if you have a 3-year cycle, you could have so far we've had an advance for 20 months. So like you could have gotten in after this little retracement, after this one, after this one. So like you're going to get a chance, so you can be patient in the same way that if you want to be aggressive and you want to short this, for instance, you wait for the monthly swing high and maybe even a back test from above that fails. Because at some point we have a date with destiny for this 10-period moving average. Now, what could end up happening, is we get some kind of messy consolidation inside some kind of range, which is essentially kind of would for all intents and purposes kind of look like a bull flag, and that would give the 10-period moving average time to kind of catch up, right? Because we would expect the 3-year cycle to end in January 2024. Like that's when we would expect our low. So it's really now just a question of when do we get the high, because that tells us how long the decline is going to last. To be clear, if month 20, last month, was the high, that means we would expect to decline for something like 16 months, right? So, to complete a 36-month cycle. Now, notice this cycle was kind of wonky in that it was only 21 months. And then this one was also wonky in that it was 23. You could say there's just actually one cycle at 44 months. So it was actually long, right? So like more than 4 years, or actually just under 4 years. This cycle was more clear-cut at 36 months. And you can see we got our high on month 27, even though, to be clear, it was actually a pretty, like a double top kind of situation, right? Like we actually, we got this high came on month 14. So that's kind of interesting, but that's month 27. That gives you some context. This one was 38 months, and we got our high on month 12. That was really bearish. This was 39 months. We got our high on month 11. So it tells you we could have gotten the high much, much earlier, and we didn't. It's also important to understand that we've made a high above these peaks, right? These last long-term cycle highs, we're now well above them. And so that also becomes when that 3-year cycle decline begins, you expect, like, again, it's not a coincidence that the 10-period moving average is around there now. Now, again, that's going to continue to move, but you expect we're going to have a date with the 104 area when we get that 3-year cycle decline. Doesn't mean that's where it'll stop by any means. Now, this will also probably cause a lot of other risk assets to kind of rally, so there'll be other ways to play this trade other than shorting this. And again, it's going to last for months. By definition, a 3-year cycle decline lasts for months. I mean, look at this 3-year cycle decline. Like, this is I mean, like, we topped out on month 6. We came out back, made this little double top, and then the bottom just fell out, and the cycle didn't bottom until month 39. So another way to say that is we declined for 33 months, a full 3 years. Now, there were rallies along the way. Like, look at this little set of this little lower high, this little consolidation, this little lower high before the final, like, flush lower. And then this next cycle topped out on month 11 and then cascaded and made a new lower low. So this was, you can think of this as like one big bearish cycle. And again, you can think about the 15-year cycle, right? A combination of 5 3-year cycles. So all that to say, breaking out of this consolidation, what appears to be what's happening here, could mean it has a protracted period of strength. The same way we had this protracted period of weakness, where we had 2 extremely left-translated long-term, 3-year cycles. It could be that we get this right-translated 3-year cycle, and then boom, we get hit with another, right-translated 3-year cycle. So it's 6 years of pretty right-translated yearly cycle, 3-year cycles, so that you get almost like a reverse symmetry move here. That'll be interesting to watch. Definitely will be covering that here on this channel for sure. So that's the Dixie, and you can see it in real time. We're starting to go green here on the daily. That's interesting. Again, this is day 16. All that matters is, well, right now for the daily specifically, you want to think about this range, right? Because it's an inside day. So, like, can we get above 111 spot 886? We'll see. I suspect we won't. That might actually be your spot for a lower high, because we'd expect the daily cycle to be at least 20 days. That's the expectation, but that doesn't mean that's definitely what we're going to get. Always follow the price action versus, myopically focusing on timing bands. So let's look at TNX. I've tweeted about this. This was a relentless rally for 8 straight weeks of higher highs and green candles on the weekly, and then we finally got a swing low. Now we still have a couple 3 days left to trade, so it could be that this recovers. But right now, this is a swing low. And this is the 10-year treasury yield. This is the yield itself. So we have a swing low below 3.686, right? And so right now, we're sitting at 3.618. So what is that? Like, okay, yeah, that's like 70 basis points, something like that. It's funny because I think the way that you would trade this is TLT, and let's look at that actually. Well, before we do that, let's just look at the monthly chart really quickly. So the monthly is just an inside month, right? We really need to break down below 3.17, right, to make a new monthly low, and we're up here at 3.6, so that would actually be a pretty big move lower. And you can see, again, thinking about the long-term cycle, this one bottomed back in 2020, and we've been rallying for 30 months. So at some point, we're going to get a pullback into this longer-term cycle low, and you can see how stretched we are above the 10-period moving average. So in a lot of ways, this chart is very similar to the dollar. You can almost say this is almost more extreme because it's been rallying for longer. That's a good way to think about cycles. This is just telling you this thing has been rallying. The advancing phase has lasted 30 months already. So at some point, it's got to pull back into some cycle low. It could be very shallow. Similar to the dollar, same kind of idea. It could be some kind of consolidation around this range. Maybe on the underside of this. So like maybe, like what's the low of this candle? So the low of this candle will take you into the, mid twos. So it could be some kind of consolidation in like the, call it like the 3.1 area, maybe even solid 3, which would be a lot of downside from here, like almost 20%, but wouldn't be catastrophic and would essentially give the 10-period average time to move up, sort of catch up. And it would essentially give you that, sort of long-term cycle low after this like really stretched trend leg. And in terms of like percentage gain, I know, there are people that are sticklers. I know this is technically wow. It's been a 700% move gain. That's pretty incredible. And that's not even from the Pico bottom, right? That's not even from the low. That's important context. At some point, this thing has to rest. And same concept with the dollar. Look at how we've swept these high, like we've taken out these highs. And so you would expect, right, that comes in and around the 3.1 area. You'd expect that level is going to be revisited at some point, and it'll be a question of can we kind of hold it. TYX is the same kind of idea. That's the 30-year chart. Same thing. It's been rallying for 30 months, and you can, at some point it's going to have to take a breather. It is an inside month. In this case, the low is 3.335, and so that would be the area that you'd, like if we broke below that, that might tell you we're going to have a longer term pause in rates, which may be what the market needs to kind of see to signal, a more durable bottom, maybe a weekly cycle low even. So that's TYX. Let's look at TLT really quick. That thing is a mess. So we still have this swing low kind of active, but I mean, we had this bearish outside day, then we had this inside day, and now more inside. So a break, if we're thinking really tactically here, a break below the 103.16 level, call it, so like 40 cents below here, probably sends us to new lows, which is interesting because rates are backing up, and this thing should move inversely to rates. It should move higher with rates, which tells me this is just, and there's more to this sort of bond fund, but it tells me this is just a poor instrument of tracking that for one, and that there's just a lot of money selling this. So we could get a false breakdown below this level too, and that's why I think it's helpful to look at that kind of pure trend instead of something like this, which is just correlated. And on the weekly chart, it's starting to look more and more like the same way we had this kind of weekly cycle, that this was, call this a 31-week cycle that has a high on week 7. It's starting to look like this is a cycle that has a high on week 7, and we're now on week 16, which would suggest we're declining into a weekly cycle low. That's far away. So that could coincide with this pause in bonds. The bond yields, I should say, could give us a lower high, right? Like as I say, things need to go higher before they can go significantly lower. So maybe like even up here before something like that, right? And then we continue to kind of stair step our way down. Could be something like that. That's what we want to kind of watch for. Or obviously, the opposite scenario where we either just keep seeing more selling, more, just straight downside, or it looks like we're going to take on the bullish scenario. So we'll have to see how best to play that. So that's TLT. And it does look like on the monthly time frame, we are on month 19 of a longer term cycle that is still declining and has been declining since month 9. That's obviously bad news bears. Still looks to me like we could see a rally back to 110 at some point. Again, thinking about making, like in that context of making a lower high and then continuing to move lower. We have swept all these lows. So you think about it like that's bullish and bearish. Like, okay, well, maybe we have all this out of the way, but that also is just a sign of extreme weakness. And we can see we've had cycles. The only saving grace is that we've had a lot of cycles that bottomed around month 20, like between month 18 and month 21. And we're now here on month 19. So that is also a clue here, right? That maybe rates are going to back up for a little bit. Maybe they don't fall off a cliff, but they back up a little bit, and this thing kind of bottoms. That could be an interesting play as I'm thinking about. But right now, solidly inside month, not really doing much besides that. And so we'll close it out looking at HYG and LQD. So this is the monthly chart for HYG. And I hope the first thing that stands out to you is the big green candle, right? It's a pretty big green candle. The other thing I would note is I think this thing has a pretty high dividend yield, right? So a dividend yield of 5%. So that's good to know about. So nice green monthly candle. That's important. But it's inside the range of a pretty large candle that has a high at 76. And so it's just important to know those levels, right? Your high is at 76 and your low is at 70.90 essentially. And you're sitting here at 73.52. Now notice we had this big green candle and then we had more downside, right? And the other thing to keep in mind, I always point this out, it's important to know this so that when you're looking at something in real time, you can think about that potential scenario, right? Like this, sorry, I'll just get rid of this thing. This candle here, just zooming in, was nice and green at one point. We know that because it's a red candle, which means it opened here and it closed here. So think about that. If it opened here and it has a wick here, think about that visually. That means at one point it rallied from here to here. To put a finer point on that, that means it opened at 77.64 and it had a high at 79, right? So at one point it rallied about, $2.40, call it, right? It rallied from 77.60 to 79. That's important to know about, but it's also equally important to know when it failed and then we saw more follow through to the downside. That's not good. This could be setting up another lower high. That's what you want to be careful of. And if we zoom into the weekly, that can give us a little clue. So we have our low last week. And if I think about cycles, I obviously don't have these marked. So I'll just do this kind of in real time. And I just kind of gauge this. So I want to say that is our low. And then something like that. And then something like that. That's a pretty long cycle. You see, these don't have to be precise by any stretch. Maybe it's actually more like that. And then you can see a cycle here to maybe here, right? That's a long one at 30. No. So if I'm thinking about it, like, yeah, if you start like here, right? You start a cycle, let's say here, that just bottomed, let's say there. So a 29-week cycle, which means this is a new cycle. Let's say it goes for 20 weeks. So you might expect that this is actually just a lower high that's going to roll over and make a lower low to complete this cycle in a few weeks, because that would make this week 16. Now, that said, we know that cycles can bottom earlier than we expect or later. So this is a swing low right now. You have to respect that. The next level on the weekly chart that we need to attack is like very clear and unambiguous. It's this high from this week, from the week before last, which in this case is 74.49. So the 74.50 area. So that's important to know about. That's just about $1 more from here. And if we make it above that level, this is like our next kind of swing high kind of area at 76.25. So almost kind of moving in $1 increments. Now, notice this rally, which was really powerful, and then just kind of completely petered out, made a lower high. So even if we get something for the next couple of weeks, you just really want to be cautious. You could see us rally into 76 and then like collapse. So you do want to be careful. That's HYG. And this is, that's high yield corporate debt, so a little bit riskier, and that's why the yield is higher. LQD is, I think, just basically better rated debt, and that has a yield of 3.13. And in this case, this is your weekly chart as well, and it's kind of following exactly the same pattern. We had this rally, massive rejection. If anything, it looks weaker. Definitely weaker. I mean, remember that green, the big green monthly candle for HYG? this is like actually pretty anemic. So this is a little bit of a tell as well. You can see we're well below the 10-month moving average. That's just another kind of clear sign of a major cycle decline. And it's also really important to note we are now below the COVID low. Now that's something that is important to know about. We've now fallen below the COVID low for LQD. Now it's going to be important to see, can we recover it? How do we react to that? And that low was 104.95. So we're going to watch that really closely. How is HYG doing in terms of that? Right. So that's your tell there, right? HYG, that made a low at 67.50, right? So we're almost, like $8 above that. Whereas we're not well below, but we're below. We are below the 2020 crash low for LQD. That's really important to know about. That's going to bear watching, especially as we see this little rally for the S&P. Like, is it real? I think, and this tells you there are much lower lows to kind of play with. This is the depths of the 2008 crash. Again, doesn't mean we're going to get something like the 2008 crash, but it is important to know where those kind of levels sit, because that's a long way down from here. And that also is the kind of thing that tells you that might be what it takes for the Fed to finally step in and say, okay, we can't completely crush the system to fight inflation. We're going to find some kind of middle ground. So that's important. That's a big development.